Hello, we are Team 4, and today we will be presenting a case analysis on WeWork. Our team members include myself, Alicia Guthrie, Zachary McRae, Isaac Reynolds, Andrew Mock, and Dilip Palanisamy. In this presentation, we will be examining WeWork's competitive and strategic positioning using a variety of tools. We'll begin with a brief company overview with a specific focus on the company's rapid growth and recent decline. Next, we'll examine the industry as a whole to put WeWork's performance into context. Following the industry outlook are traditional SWOT and 5 forces analyses to compare WeWork's strengths and strategies against the industry. Finally, we'll conclude with a closer look at specific strategic issues facing the company. Founded in New York City in 2010, WeWork aims to offer modern workspaces for modern businesses, fostering a community of professionals and building lasting networks. Their shared office spaces emphasize open aesthetics, with sponsored events and amenities evoking comparisons to the most successful tech startups. The company's aggressive investment has grown their real estate portfolio to over 800 locations with 15,000 employees and over 500,000 subscribers to their member network. This growth culminated in revenues as high as $1.8 billion in 2018, their second consecutive year with over 100% growth. Since 2010, WeWork has raised over $12 billion in funding. Their investments beyond real estate, including the acquisitions of Flatiron School and Meetup, have helped the company to diversify its holdings and expand their service offerings as the We Company. WeWork's clientele list has also grown in both number and status, turning a service aimed at startups into an attractive offering for the world's biggest corporations on the Fortune 500. WeWork's valuation topped at around $47 billion in early 2019 as the company launched plans for their initial public offering. While WeWork's rise to the top peaked in early 2019, their fall swiftly came after. In August of 2019, WeWork filed their S-1 prospectus, which showed major losses in revenue since 2016. In 2018 alone, WeWork lost $1.6 billion on $1.8 billion in revenue. The next month, co-founder and CEO Adam Neumann announced he would be stepping down as CEO amidst backlash from investors. As a result, WeWork's planned IPO was delayed and their valuation declined to $10 million, which is less than the amount of capital raised by the company. With WeWork's IPO delay and major changes in corporate governance, the company is now facing both internal and external pressures to build a more sustainable business model and restore confidence in the company.
In this section, we'll take a look at the overall co-work industry and the trends that we're starting to see. Overall, it appears that the industry is at an all-time high, and while 2019 won't see the same year-over-year growth as in 2018, there still is an upward trend and room for growth. In 2018, an estimated 2,188 spaces were open worldwide, out of which almost 1,000 were in the U.S. This year, the co-working space market size is expected to reach 696 openings in the U.S., many of them in states and cities with budding startup cultures. Our projections show that in 2019, growth will be slower than in the previous year, although the industry continues to grow at a strong pace. While most of the industry growth can be attributed to new spaces, a large portion is owed to existing spaces diversifying their services or acquiring businesses and expanding into smaller niche markets that generally have stronger, more close-knit communities. Year-over-year growth compares one period with the same period from the past year. The growth figures for 2019 indicate less expansion, but may also represent the industry's focus on growing existing spaces by increasing occupancy rate and profitability. The number of co-working spaces worldwide is projected to soon cross 20,000 and reach 25,968 by 2022, an increase of 42% from 2019. This would also mean that there has been an average increase of 2,595 new spaces every year since 2015. Looking at the number of WeWork spaces and boutique spaces around us today, this shouldn't come as a surprise. Now, we have categorized co-working spaces as such: new spaces, which indicates a brand new business; expansions, which would indicate companies opening their second location or more; and thirdly, chains, which indicates large co-working chains and franchises. Of the new spaces that open each year, brand new businesses make up the bulk of it at 65.3%, while chains and second or more locations make up the remaining 34.7%. This means that while existing companies are thriving, the majority of the industry's growth still comes from firms, independent business owners, and entrepreneurs entering the market for the first time. In our international analysis of the top 50 major countries with the highest density of co-working spaces compared to their population, Luxembourg, Singapore, and Ireland stand as the top three, with Luxembourg coming in first at 8.5 new spaces every year for every 1 million inhabitants, almost double that of the other two. Considering that Ireland and Singapore are both smaller countries with a population of only about 5 million people, co-working has made a big splash in these regions. The UK ranks 5th, Australia 6th, and Canada registers a slightly higher growth than the US, ranking respectively 7th and 8th worldwide. Focusing just on the United States, today we see that the most growth is seen in Vermont, with 12.1 spaces opening every year per 1 million people. This growth can be attributed to Vermont's rising startup scene and Burlington's bustling innovation hub. Coming in second is the District of Columbia with 11.1, Montana with 8.5, and Colorado at 8.0. New York, already dense with flexible offices and co-working spaces, is still coming in at 7, with 4.4 spaces opening every year for every 1 million people. The top state in terms of the most yearly openings is none other than California, with its ever-growing entrepreneurial scene and wide range of businesses. Texas comes in a close second, with employment rates rising in 2019. Moving on to take a closer look at WeWork, as noted here in the company's historical financial results, they are on a high revenue, high burn rate trajectory. The good news is that they expanded their revenue by 94% on a year-over-year basis in Q3 2019 to $934 million. The flip side of that news is that they lost $1.25 billion on a net basis in the same quarter. According to CNBC's read of the figures, the company's run rate was 108% from the year ago period. Even for WeWork, the losing of $1.25 billion is shocking, as the company lost $1.9 billion in all of 2018. Understanding this, it now comes as more of a surprise that WeWork made it as far as they did in the path to going public. A company that is willing to spend $2 in every quarter for every $1 in revenue that is brought in is not on the right path. This could be explained away in the early stages of a company as they tried to build, but for a company the size of WeWork, it's unsustainable. They will have to make drastic changes to stem the tide of losses while keeping their revenue on track.
In continuing our discussion of WeWork, let us now take a few minutes to peer through a brief SWOT analysis of this towering yet tumultuous organization. To begin, let's look at the strengths of WeWork. WeWork has developed a reputable brand image within society. The organization essentially cornered a niche sector of the real estate market focused on creating unique and effective spaces. The company has developed a highly user-centric experience, such that the human capital is not necessarily a premium acquisition. There is an abundance of not just offices, but also workers to utilize and implement these creative insights. Now, there's a large-scale movement in today's economy for more cooperative and collaborative co-working and shared office layouts to maximize productivity and minimize auspicious sensibilities in the work environment. WeWork is actually evolving with the up-and-coming millennial generation. This new generation has a magnanimous access to an abundance of resources that were mostly unimaginable many years ago. Now, it's imperative that a company in today's times keeps up with the millennial generation, as this is the one driving technology and driving change moving into the future. What WeWork is doing from a philosophical perspective is creating unity and instilling this notion of collaboration in a highly fragmented society. Today's times are very divisive, people choosing extremes, and what WeWork is trying to do is bridge the gap, create mediums, create change. WeWork epitomized the capitalist ambition and cooperative friendliness in their elevator pitch. This company idealizes the humanization of workspaces, essentially moving away from dark and dreary to endlessly creative and constantly inviting spaces. Moving on to the weaknesses. WeWork is an organization ripe with internal politics. Management and employees constantly disagreeing on customer acquisition, market share, leadership mentality, and exclusivity in product and commercialization. Now, these internal politics, as everyone knows, leads to a dead standstill. No progress is made, no change is made. There is clearly an apparent lack of diversity in the product lines. Not much flexibility in the SKUs and very standard methods of operation. This does not bode well in terms of maintaining strong competitive natures in the market, especially in the real estate market. Now, going off an earlier point, it does not seem that management is up to the task of leading the company into the future and seeking avenues for sustained growth. Now, there's no reason to be in business in today's times if you are not constantly seeking out new avenues, new resources to create a more robust working environment, create a more robust competitive nature, both internally and externally. Finally, with respect to competitors in the market, WeWork is extremely expensive. Looking at the opportunities, WeWork has a business model that is primed to evolve. It is simply a matter of buckling up and hitting the gas pedal. Everything is in front of WeWork, and it is up to them to grab it, to use it, to effectively create change with their mission statements. WeWork has branded themselves as a disruptive revolutionary. The big picture focus is encapsulating the energy and spirituality in this co-working schema rather than develop tunnel vision on dollar signs. Some well-known examples of disruptive revolutionaries in society include Google, Apple, Uber, Facebook, and Microsoft. If WeWork follows in the footsteps of these disruptive revolutionaries, the company has the potential to revolutionize society's behaviors and actions for decades to come. The niche market attraction spurs on continued growth, somewhat banking on the idea of increased productivity. That is the model for today's times. It's very results driven. Everybody wants to see high output. There's a global shift in demographics. The millennial generation is up and coming and is waging a war on the previously inhibited creativity, and the baby boomers now are slowly losing their voice in this battle. It is up to the millennials to engage if they want change and reform. There is a gentrification of neighborhoods, like Detroit, for example. Detroit provides a great opportunity to showcase what WeWork can do with desolate parts of the town, run down buildings, run down architecture, and provide vibrant environments for the society to thrive. Remote work and work from home is a growing trend across all sectors like software and data analysts. Now, this will not apply to many sectors like healthcare or engineering, but for those where work from home is highly applicable, this is a key aspect. Finally, a massive opportunity for WeWork rests in the utilization of big data and advancements in tech to tailor specific work environments, architecture, and locations for clients. It's all about creating the perfect setting to be able to produce the most amount of output. Lastly, the threats facing WeWork. There is a reluctance by communities to accept this real estate, corporate, and cultural shift in workspaces. People are questioning not only the validity, but also the necessity of WeWork. Why can't people go to stores like IKEA, purchase furniture and office space furniture, create their visions, and use those to enable productivity? There are new entrants and competitors to the market like Spaces and Convene that have similar models, but most importantly, at a much cheaper rate than what WeWork is offering. WeWork has to deal with the constantly evolving customer needs. One day, the customer may want green chairs with neon purple desks and flowers in the corner. The next day, no flowers in the corner and neon blue chairs with crimson red desks. Finally, economic instability. Literally not one single person knows what the market will look like next week, next month, or next year, let alone tomorrow. That constant uncertainty and sporadic fluctuations can and will hurt WeWork's bottom line.
A useful tool for analyzing the competition that a business faces is Porter's Five Forces framework. It can allow an existing company to evaluate its threats, or for a new company to evaluate a possible market as being unattractive or attractive to entry, looking at its competitiveness. Most importantly, a company can be evaluated on its value and its competitive strategies with some of the forces in the framework. A few years ago, WeWork would have fared much better in this analysis than it does today. Over time, and plagued by some bad choices and controversies, it has allowed the threat of new entrants, substitutes, and rivals to increase. It has also allowed the bargaining power of customers and suppliers to build as well. Let's look at the 5 forces analysis in a little more detail for WeWork and the real estate industry in which it resides. The threat of entry is moderate for WeWork. The largest barrier for a new entrant into this industry is to have a large amount of capital on hand in the beginning. More companies breaking through this barrier in one of two ways. The first is these are taking their existing company and making a separate branch off of it for co-space leasing. This still allows them to share in the overall company resources, but also be segmented enough to do the work their way. The second way is for these companies to acquire capital investments through other companies in forms of partnerships or heavy backing. Many of these companies, including WeWork in the past, have broken this barrier this way. Technology and government regulations are not high in this industry and does not provide much resistance to entry. However, another deterrent to entry is the volatility of the market in general. The real estate market is known for its ups and downs, especially in times of major recession or productivity in the overall economy. The threat of rivalry is moderate as well. WeWork is in the real estate industry, and segmentation is the way this market works. WeWork now goes for spaces that are larger and also targeting larger companies. This is why they have become the largest tenant in Manhattan based on square footage owned and or leased, recently passing JP Morgan Chase. Although there are many competitors in this market, most of those focus on smaller scale locations due to their lower capital to spend and also a new virtual space leasing frame of mind. The properties and occupants for those that WeWork targets is a different demographic than its competitors. WeWork also differentiates itself from the normal commercial real estate market in that it changes with the customers and their needs, specializing these spaces instead of just leasing and letting them have them. WeWork is also aware of their competitors. Just recently, they bought Naked Hub for $400 million. This will allow easier expansion into Asia, and they also own a significant piece of The Wing, which is a woman-focused co-working space company. They are doing things to try to head this off. The threat of substitutes is low. Most of these do what they should by making themselves stand out by offering something extra or hitting a certain niche to give the appearance of more value. ServCorp, DaVinci, and Regus are virtual space companies. And what this is, it means the physical space is limited, but through certain techniques and services, these businesses will make your smaller business appear bigger to others on the outside. An example is they will offer a receptionist to you to answer your direct calls, even if it's just for 2 workers in the business. These smaller companies are limited, but they offer some of the top services at the best price in the industry. They just don't have the same market segment as WeWork. ShareDesk is a substitute as well if you are a freelancer or a solo entrepreneur looking for short-term or temporary office space. This can keep costs down as they offer hourly, half-day, or even daily rentals. Regus is probably the most powerful substitute as it caters to the more professional type setting compared to WeWork, as their spaces are considered more for the hip, collaborative, open network that the younger generation desires. The reason substitutes are low is because of sheer size. Size alone does not eliminate others, but being a substitute and having less properties and a smaller supply chain does make it hard to be a pure substitute. The powerful supplier threat is high. There are several types of suppliers in this industry. The most powerful is the capital provider SoftBank for WeWork, or what used to be SoftBank. SoftBank invested billions into WeWork, but as valuation of the WeWork business dropped, it declined to bail them out. This month, SoftBank chose to write down its asset loss to WeWork at $4.3 billion. The capital investment is gone, and WeWork is struggling more and more every day to do this and to find a replacement. This dependence makes the supplier threat very high. They basically control what you can do and how much you can grow. There are some less prevalent but still powerful suppliers outside of capital investors. The landlords of these properties have some power, as they are the owners and sellers to these companies. However, the real estate market is competitive, and due to so many available options for office space, it limits their power. That is not to say that this person who owns a big space at the best location doesn't get more money, because they will. However, the market segmentation reduces this down some. WeWork is doing a better job of fending off material suppliers through its solid supply chain, which is far and above greater than all the other competitors. Most recently, as WeWork has rebranded itself to the We Company, it has started its own construction segment. This is an attempt to deplete the power of outside construction contractors and to be able to keep this within in-house. This all allows them to be more flexible in different areas of the country and hopefully globally. The threat of powerful buyers is moderate. These buyers' power is limited based on segmentation of the market and what they are looking for. There are many buyers, from single entrepreneur businesses to massive corporations. WeWork started with smaller companies to lease to. This also brought along more risk of payment and consistent income. So their strategy shifted to targeting Fortune 500 companies, and these companies have more power but are also more dependable. These large companies are interested in more of a long-term lease, which is also more stable for income for WeWork. Customers include Microsoft, Salesforce, Starbucks, Samsung, Spotify, Pinterest, Facebook, and others. While this strategy has helped with risk aversion, it also allowed more competitors into the market, working with smaller companies as WeWork once did. WeWork has recognized this, and they are starting to implement things like first month free incentives in order to steal these buyers and other clients back. They're also doing things like shorter term leases. This year, WeWork rebranded itself as a We Company. This is to have the capabilities to grow outside of just the co-working and real estate market, and also has the data to learn from and fight off these threats.
So the next part of the presentation that we'll be discussing is WeWork's strategic issue. When we actually dig into WeWork's strategic issue, it is pretty evident that WeWork had positioned themselves as both a tech company and also a disruptor in industry. So what do I mean by that? Well, they marketed themselves as an office floor intermediary and a tech company that brought a new and innovative way of doing things. One of its promoters actually stated that technology is at the foundation of the company's global platform. Now, that's pretty interesting to see, as technology is becoming more of an integral part of any business nowadays. However, when we actually look into WeWork, WeWork is actually no more than an office rental company that acts as a middleman between landlords and short-term tenants. Its business model is something that has already existed for decades with other companies such as Regus and Surfcorp. At the start, WeWork had a number of things going for it. It was led by a young, dynamic, and charismatic CEO/founder by the name of Adam Neumann. He was able to persuade the investors not only that his idea was a viable undertaking, but actually got his whole project fully funded. Because of this, it actually led to a rapid growth in its early stage. Now, with WeWork and its rapid growth, the growth never really translated into profitability. Rather, it actually concealed bigger issues. When we look at the company's revenue in 2017, it was almost 900 million, which actually doubled in 2018 at 1.8 billion dollars. Now, while revenue was actually climbing, the company's overall cash flow was becoming really negative. In 2017, its EBIT was negative 770 million, which eventually grew in 2018 to about $1.4 billion. So, in the aftermath of all of this debacle, Newman actually resigned from his position, and the company has taken desperate measures to right itself. One of the things that it actually did was sell off its $60 million Gulfstream corporate jet. But not only that, unfortunately, it actually laid off thousands of employees. Now, even with all of this said, the real problem with WeWork really lies within its business model and how flawed it is. There's really nothing special what they do, and WeWork was actually exposed. WeWork is currently working on a few strategies. This includes restructuring of its business model, such as shared spaces, targeting more enterprise clients, shifting into co-management deals from its current leases, purchasing properties, and most importantly, going for longer lease terms for its members. Now, lengthening its lease terms will actually help diversify its overall membership and service offerings. This actually helps transition the company into larger deals and larger accounts. So when we actually go into acquisitions with WeWork, we see that WeWork actually acquired 21 startups since 2015. Details of these deals were never really made public, but we have an idea that WeWork actually paid roughly $40 million for Flatiron School. Now, this is a school that specializes in coding. Another deal that we saw was Space Mob. Now, Space Mob is a Singapore-based co-working startup, which WeWork actually spent almost $500 million. Now, you can see there's a lot of different types of acquisitions included. However, some of the ones that are more notable is Welkio, an office sign-in system, and Euclid, which is a physical data software company. These acquisitions help move the company into a domination in the business sphere. Going into the organizational structure, so an organizational structure is supposed to really indicate how a company is structured from a reporting standpoint and sometimes from an operational standpoint, although not always. It is usually a good indicator of where information sits within an organization and how that information tends to flow. Now, looking at the chart in the slide above, we see that WeWork's organizational structure really is convoluted, which helps us lead to the reason why their overall effectiveness of the flow is actually flawed. Now, they're working on restructuring their business model, but they're also working on restructuring their organizational structure. So now we look at the future impacts of decisions. One of the main topics within this presentation revolves around Newman's resignation. So if you don't remember, Newman was actually the former CEO and founder of WeWork. And when we look into it, one of the main push for Newman's resignation was actually from SoftBank, who spent nearly $10 billion to take control of the company. And with this being said, Newman's resignation only led to one question: who's next? WeWork's current co-CEOs are Artie Minson and Sebastian Gunningham. They've only been in this specific position since September. However, with this being said, the company's majority owner, as I mentioned before, SoftBank Group, is very eager for a fresh change in the company, especially after the botched effort to go public this year. Well, since taking control of the company, SoftBank actually installed its chief operating officer, Marcelo Clar, as the executive chairman of WeWork. So SoftBank has been talking about, the need for the company to really make changes, or specifically to return to its core, such as renting out trendy office spaces to freelancers and enterprises. One of the things about Newman was that he basically did some moves within the company, and the company headed towards a direction that wasn't what the company was based upon, such as education. So when we talk about the next CEO, there's a lot of different talks out there about who's the next CEO, what potential candidates are there. There's only one that's been reported that's is most likely going to happen. However, the two companies that's involved with this hasn't made any comment, and that's between WeWork and T-Mobile. The U.S. wireless carrier T-Mobile CEO John Legere is reportedly to be in talks with the company. And when we look at another decision between the company, is on the rebrand of the company itself. When we talk about rebrand, it can either make or kill a company from the inside out. Well, after the rebranding of WeWork to We, or the We Company, it's pretty much proven that the name change was not really necessary. There are various articles out there, that still refers to the company as WeWork rather than the We Company. And so with all this being said, there's a lot of changes that's in motion, really specifically from, the push from SoftBank, who's now the majority owner. It's really interesting how everything's going to turn out. So at this time, we just want to say thank you for being here for our presentation. We've worked really hard on this. Alicia, Guthrie, Zach McRae, Andrew Mogg, Dilip, Palanisamy, and Isaac Reynolds. Hope you guys enjoyed it.